everyone, welcome back to the channel. Today, I'm diving into an interesting topic, the relationship between interest rates and bond prices. It might sound a bit tricky, but don't worry, we'll break it down with a fun story. Ready? Let's get started. In the vibrant town of Numisphere, there was a savvy investor named Benny who loved collecting magical bonds. These bonds were like enchanted scrolls that promised Benny a set amount of money in the future. Benny had a whole collection of these bonds, but he noticed something curious. When interest rates went up, the value of his bonds seemed to go down. Let's find out why with a little help from his friend, Clara the financial wizard. Clara explained to Benny that the relationship between interest rates and bond prices is a bit like a magical seesaw. When interest rates rise, bond prices tend to fall, and when interest rates fall, bond prices tend to rise. Here's how it works. Benny's bonds promise a fixed interest payment called the coupon rate. For example, if Benny has a bond that pays $50 a year and he bought it for $1,000, the coupon rate is 5%, $50/$1,000. Now, if new bonds are issued with higher interest rates, say 6% instead of 5%, they become more attractive to investors because they offer better returns. So, Benny's old bonds with the lower 5% rate aren't as appealing. To make his old bonds competitive in this new environment, their prices need to drop. Imagine if Benny wanted to sell his old bond. Since it pays only $50 annually compared to the new bond's $60, he'd have to sell it at a lower price to attract buyers. That's why bond prices go down when interest rates go up. Clara used a seesaw analogy to make it clearer. When interest rates go up, it's like one side of the seesaw going up. This means the other side, representing bond prices, goes down. Investors prefer the new bonds with higher interest rates, so the value of existing bonds decreases. Conversely, if interest rates fall, new bonds offer lower returns. This makes Benny's old bonds with their higher fixed rates more valuable. So, the price of existing bonds goes up to reflect their more attractive returns. Let's say Benny originally bought a bond for $1,000 with a 5% coupon rate. A year later, interest rates rise to 6%. New bonds pay $60 a year. Benny's bond, which still only pays $50, isn't as attractive anymore. To sell it, he might have to lower the price to, say, $900 to compete with the new bonds. On the flip side, if interest rates drop to 4%, new bonds pay only $40 a year. Benny's bond, paying $50, looks pretty good now. Its price might rise to $1,100 because it offers a better return than the new bonds. Clara wrapped it up by saying that understanding this seesaw effect is crucial for investors. When you know how interest rates impact bond prices, you can make more informed decisions about buying and selling bonds. And that's the scoop on the inverse relationship between interest rates and bond prices. I hope this story made it clear and engaging. If you enjoyed it and found it helpful, give it a thumbs up, subscribe for more awesome content, and let me know in the comments if you have any questions or if there's another topic you'd like to explore. See you next time.